3 hours ago, silver hit $94.53, a 41% vertical climb in 30 days. But the mining stocks, only up 16%. Wall Street is calling it a speculative frenzy. They are telling investors to wait for the pullback. But what they are not telling anyone is that physical silver has become unobtainable. The largest dealer in the world just instituted a $500 minimum and cut their output by 50%. Shanghai is paying $9 more per ounce than New York, draining Western vaults in real time. The math says mining profits just doubled, but the stock prices haven't moved yet. When the earnings reports drop in 3 weeks, this 25% lag will disappear in a single afternoon, and most investors will never see it coming. Welcome to John Analyst. If you have been following markets long enough to remember when fundamentals actually mattered, when a balance sheet meant more than a tweet, then you're in the right place. This channel does not chase hype. It follows the money. If that sounds like the kind of analysis you have been looking for, hit that subscribe button, not because it helps the algorithm, but because when the next structural shift happens, you will want to be positioned before the headlines arrive. And before we continue, drop a comment below, tell us where you're watching from, New York, London, Singapore, Deepalpur, let us know. Because this is not just a story about silver. It is a story about a global reset happening in real time. And it is playing out differently depending on where you are standing. Now, let us get into what Wall Street is refusing to acknowledge. On a Tuesday afternoon in January 2026, a seasoned commodities analyst sat at his desk on the East Coast, staring at a number that made no sense. Silver, $94.53 per ounce. He had been tracking precious metals for 12 years, through bull markets and crashes, through rallies that fizzled and corrections that bled fortunes. But what he was seeing on his screen that day was different. This was not just a price move, this was a dislocation. In the span of 30 days, silver had climbed 41% vertically. No consolidation, no meaningful pullback, just relentless upward pressure. And yet, the silver mining stocks had barely budged. The SIL ETF, which tracks the largest silver producers in the world, was up only 16%, a 25% lag. He leaned back in his chair and did the math again, checking his data sources, refreshing the terminal, hoping he had missed something. But the numbers did not change. The financial media was already spinning their narratives. CNBC called it a speculative frenzy. Bloomberg warned of 2011-style market PTSD. Analysts on Twitter were posting charts comparing this rally to past crashes, all of them saying the same thing, wait for the pullback. But he knew something they did not. He knew that the real story was not happening on the charts. It was happening in the vaults. That morning he had called 3 major bullion dealers, asking about availability. The first dealer told him they were limiting orders to $500 minimums, an unprecedented move. The second dealer said they had cut their output by 50% due to supply chain constraints. The third dealer simply said, "We are out." This was not normal market behavior. This was not profit-taking or speculative exhaustion. This was a supply crisis unfolding in real time. And yet, Wall Street was treating it like noise. He pulled up the valuation data for the global silver mining sector. $300 billion, that was the combined market capitalization of every silver mining company on Earth. For context, Netflix was worth $400 billion. Home Depot was worth $380 billion. A single home improvement retailer was valued higher than the entire industry responsible for extracting one of the most critical industrial metals on the planet. He stared at that comparison for a long moment. Something was fundamentally broken. The analyst understood operating leverage better than most. He had spent years modeling mining companies, watching how small changes in commodity prices created massive swings in profitability. But this was not a small change. At $94 silver, with average all-in sustaining costs around $20 per ounce, these companies were generating $74 in profit per ounce. Just 6 months ago, when silver was trading at $55, they were making $35 per ounce. That was a 69% increase in the metal price, creating a 108% increase in profit. And the market had not priced it in yet. Why? Because the quarterly earnings reports had not been filed. The analysts covering these stocks were still using outdated models. Models built on $55 silver assumptions. Their price targets reflected a world that no longer existed. But in 3 weeks, the Q1 earnings would drop, and those models would shatter. He checked the Shanghai Futures Exchange. Silver was trading at $103 per ounce, a $9 premium over New York. That was not a pricing inefficiency. That was a gravitational pull. Arbitrage traders were buying silver in London and New York at $94, shipping it to Shanghai, and selling it for $103s and $8.50 profit per ounce after costs. Risk-free. So they were doing it again and again and again. until the Western vaults ran dry. The COMEX inventories were already falling. The SLV ETF was seeing outflows as physical metal was pulled to meet Eastern demand. And when those vaults emptied, the paper market would break. He had seen glimpses of this before. In 2020, when the futures market went into backwardation, when some contracts were settled in cash because the physical metal was not available. But this felt bigger. This felt like the beginning of something Wall Street was not prepared for. The analyst looked at the 25% lag again, mining stocks trading as if silver was still at $55, while the metal itself screamed toward $100. Most people would see that gap and assume the metal was overpriced. They would assume the miners were correctly valuing a speculative bubble about to burst. But he saw it differently. He saw the gap as a coiled spring, compressed by disbelief, held down by outdated models and institutional inertia. And when that spring released, when the earnings reports forced Wall Street to update their assumptions, the move would be violent. He opened a new document and began outlining his thesis, not for clients, not for publication, but for himself, because in 12 years of analyzing commodities markets, he had never seen a setup this asymmetric. The math was screaming. The physical market was screaming. And Wall Street was not listening, but they would. In 3 weeks, when the earnings tsunami hit, they would have no choice. The analyst had a ritual. Every morning before the markets opened, he would sit with a cup of black coffee and run scenarios. Not predictions, not guesses, just math, cold, mechanical, unavoidable math. And on this particular morning, the math was telling him something Wall Street refused to hear. He pulled up a blank spreadsheet, no templates, no pre-built models, just raw data and formulas. At the top, he typed operating leverage, the mechanism they are ignoring. Most investors did not understand operating leverage. They heard the term thrown around in earnings calls, mentioned in analyst reports, but they never truly grasped the mechanics. And that ignorance was about to cost them a fortune. He started with the basics. A silver mining company has fixed costs. Diesel fuel for the trucks, wages for the miners, electricity for the processing plants, permits, insurance, maintenance. These costs do not change much whether silver is at $50 per ounce or $90 per ounce. The machines still run. The workers still get paid. The ore still gets crushed and refined. Industry average, $20 per ounce in all-in sustaining costs. Now, if silver is trading at $55, the company makes $35 profit per ounce. Simple subtraction. But here's where it gets interesting. If silver jumps to $94, the costs stay at $20, but the profit becomes $74 per ounce. He sat back and stared at those two numbers, $35 versus $74. That was not a 69% increase in profit, matching the 69% increase in price. That was a 111% increase in profit, more than double, because the fixed costs act as a fulcrum, amplifying every dollar of price movement into exponential profit growth. He created a simple analogy in his notes, something his grandfather might have understood. Imagine running a lemonade stand. It costs 50 cents to make each cup. Labor, lemons, sugar, ice. If you sell lemonade for $1, you make 50 cents profit. Now imagine the price of lemonade suddenly doubles to $2. Your costs are still 50 cents. But your profit just tripled from 50 cents to $1.50. A 100% price increase created a 200% profit increase. That was operating leverage. And it was happening right now across the entire silver mining sector. But Wall Street was not pricing it in. He opened another tab and pulled up analyst reports from the major investment banks. Goldman Sachs, price target based on $50 silver. Morgan Stanley, $60 silver assumption. JP Morgan, $55 silver base case. Every single one of them was anchored to a price that was $30 below current reality. Their earnings models were built on $35 profit per ounce, but the companies were generating $74 per ounce right now. Today, this very moment. He ran a stress test. What if he was wrong? What if silver collapsed tomorrow? He typed in a 20% correction from current levels. That would take silver down to $75. Still painful for the bulls who bought at the top. But at $75 with $20 costs, the profit per ounce would be $55. That was still 57% higher than what Wall Street was modeling. Even in the bearish scenario, even if silver gave back a fifth of its gains overnight, the mining companies would still be printing money at levels analysts were not expecting. He highlighted that line in yellow. This was the safety margin nobody was talking about. The analyst leaned forward and opened the SIL ETF chart. Silver up 41% in 30 days. SIL up 16%, a 25% gap. In 12 years of tracking this sector, he had never seen a divergence this wide. There were only two explanations. Either the market believed silver was about to crash, that this rally was fake, built on speculation and momentum with no fundamental support, or the market had not yet realized what was happening, had not done the math, had not connected the dots between $94 silver and 111% profit growth. He believed it was the latter, because the physical signals were too strong to ignore. Retail dealers could not keep inventory. Shanghai was paying a $90 premium over New York. And most importantly, the structural deficit was real. For 5 consecutive years, the world had consumed more silver than it produced, 150 million ounces per year. That deficit did not exist because of investment speculation. It existed because of industrial demand. Solar panels needed silver. Electric vehicles needed silver. Electronics, medical devices, water purification systems, all of them required physical metal that could not be substituted. And you could not print more silver. You could not download it. You could not create it with monetary policy. The only way to get more supply was to dig it out of the ground. And that took time. A mining company that discovered a massive silver deposit today would not produce a single ounce for 10 to 15 years. Exploration, permitting, financing, construction. The timeline was geological, not financial, which meant that even if silver hit $200 tomorrow and every CEO in the sector started greenlighting projects, the supply response would not arrive until the late 2030s. The analyst closed his eyes and let that sink in. A structural deficit that could not be solved by higher prices. A metal trading at $94 while analysts modeled $55. Mining stocks lagging by 25% while profits doubled in real time. And in 3 weeks, the earnings reports would land. Companies would report numbers that Wall Street was not expecting. Analysts would scramble to update their models. Upgrades would start flooding the news wires. And the institutions that waited for confirmation would panic buy into a market with no liquidity. He opened a new tab and checked insider trading filings. Over the past 2 weeks, executives at 3 major silver producers had purchased shares, not options, not restricted stock grants, actual open market purchases with their own money. These were the people who saw the balance sheets before anyone else. They knew what the next quarter's earnings would look like, and they were buying. He saved the spreadsheet and stood up from his desk. The math was done. The thesis was clear. Now it was just a matter of time. At 2:47 a.m. Eastern Time, while most of America slept, a trade was being executed, not on the New York Mercantile Exchange, not on the COMEX floor, but 7,000 miles away in Shanghai. A single silver contract settled at $103 per ounce. The analyst woke to the notification on his phone, rubbed his eyes, and checked the timestamp twice. $103 in Shanghai, $94 in New York, a $9 gap. He sat up in bed and opened his laptop in the dark. This was not a glitch. This was not a temporary spike. This was the 3rd consecutive session where Shanghai had paid a massive premium over Western markets. And premiums like this did not happen by accident. They happened when someone desperately needed physical metal and could not get it anywhere else. He pulled up the arbitrage calculator he had built years ago, buy silver in London at $94, ship it to Shanghai, sell it at $103, minus shipping costs, approximately 50 cents per ounce, minus insurance and handling, another 20 cents. Net profit, $8.30 per ounce, risk-free, guaranteed, instantaneous. Any trader with access to both markets would execute this trade all day, every day, until one of 2 things happened. Either the premium collapsed, or the Western vaults ran empty. He checked the COMEX inventory data. Registered silver, down 4.2 million ounces in the past week. Eligible silver, down another 6.8 million. The metal was leaving, flowing east, following the premium like water flowing downhill, and once it left, it was not coming back. The analyst had studied arbitrage flows for over a decade, but he had never seen anything move with this kind of velocity. Normally, premiums between markets stayed tight, maybe 50 cents, $1 at most, but 9. That was not a pricing inefficiency, that was a scream. He clicked over to the SLV ETF holdings page, the largest silver ETF in the world. 2 weeks ago, it held 487 million ounces. Today, 471 million. 16 million ounces redeemed. Institutional investors were pulling physical metal out of the ETF, not to sell it, but to ship it, because the arbitrage profit was too large to ignore. He opened a new browser tab and navigated to the APMEX website, America's largest online precious metals dealer. The homepage had changed. A banner across the top read, "New order minimum $500. He clicked through to the silver section. 90% of the products were listed as out of stock or pre-order only. American Silver Eagles, 8-week delivery delay. Canadian Maples, 6-week delay. Generic rounds, sold out. He had been stacking physical silver since 2014. Through the 2020 COVID panic, through the Wall Street bet squeeze in 2021, through every retail frenzy and supply scare the market had seen. But he had never seen dealer inventories this bare. This was not a temporary shortage. This was systemic failure. He scrolled down and found the statement buried at the bottom of the page. Due to unprecedented demand and global supply chain disruptions, APMEX will be reducing output by 50% effective immediately. 50%, half their normal flow. Gone. The analyst closed his laptop and walked to the window. Outside, the city was still dark. But across the Pacific, the sun was rising over Shanghai. And in those markets, silver was trading at prices that made no sense, unless you understood what was really happening. This was not about speculation. This was not about traders chasing momentum. This was about a physical metal becoming unavailable in the West. While Eastern buyers paid whatever it took to secure supply, he thought back to 2020, March 23rd. The day the oil futures contract went negative, traders holding paper contracts were forced to take physical delivery, but there was nowhere to store it. The tanks were full, so the price collapsed to minus $37 per barrel. Traders paid people to take oil off their hands. Silver was the opposite problem. The paper price said $94, but if you wanted actual metal in your hand, you paid $103 in Shanghai, or you waited 8 weeks in America, or you could not get it at all. And when paper diverges from physical, when the contracts no longer represent real deliverable metal, the paper market breaks. He had seen early signs of this in 2020. Futures contracts going into backwardation, some contracts being settled in cash instead of metal because the refineries were shut down. But this felt different. This felt permanent. The deficit was not temporary. The demand was not speculative. Solar panel manufacturers needed silver to build their products. Electric vehicle companies needed it for circuit boards and batteries. Electronics firms needed it for conductivity. Medical companies needed it for antimicrobial coatings. These were not investors who would panic sell when the price dropped. These were industrial consumers who had no substitute. If they could not get silver, their production lines stopped. So they paid the premium. They paid $103 in Shanghai. They locked in long-term supply contracts. They did whatever it took. And every ounce they pulled from the market was one less ounce available for the next buyer. The analyst returned to his desk and pulled up a chart showing global silver production. 2024, 830 million ounces mined. 2025, 842 million ounces projected. A 1.4% increase. Now he pulled up the demand data. 2024, 987 million ounces consumed. 2025, 1.0 billion ounces projected. A 2.3% increase. The gap was widening. 157 million ounces. The deficit had to come from somewhere. Above ground inventories, ETF redemptions, recycled scrap. But those sources were finite, and once they were exhausted, the price would not just rise, it would gap. $10, $15, $20 in moves in a single session. Because there would be no inventory to absorb the buying pressure. He checked the time, 4:18 a.m. The New York markets would open in 4.5 hours. And when they did, he knew exactly what would happen. Traders would see the $9 Shanghai premium. They would see the COMEX inventory draws. They would see the APMEX supply failures. And some of them would connect the dots, but most would not. Most would keep watching the ticker, waiting for a pullback that the physical market would not allow. Because you could not short a deficit. You could not trade technicals against industrial demand. You could not wait for $60 silver when the metal was disappearing from the vaults at $94. The analyst saved his notes and closed his laptop. In 3 weeks, the quarterly earnings would drop. Mining companies would report profits that Wall Street was not modeling. Analysts would upgrade their targets. Institutions would start buying. But the smart money was not waiting 3 weeks. The smart money was watching Shanghai. And Shanghai was screaming. The analyst sat alone in his office on a Friday afternoon. The markets had closed 20 minutes ago. Silver had finished the week at 12, up another 62 cents, still climbing. He opened a fresh document and typed a single word at the top, positioning. Because understanding what was happening was only half the equation. The other half was deciding what to do about it. He had spent 12 years analyzing commodities markets, watching rallies that looked unstoppable collapse overnight, watching crashes that seemed terminal reverse into historic bull runs. And the one lesson he had learned above all others was this: timing mattered more than being right. You could have the perfect thesis, the correct analysis, the data on your side, and still lose money if you entered too early or too late. So he built frameworks, not predictions, not guarantees, just conditional plans based on observable triggers. If X happens, do Y. If Z changes, adjust accordingly. He divided his screen into 3 sections: Phase 1, Phase 2, Phase 3. Each phase had a trigger condition, a target allocation, and a risk profile. This was not guesswork. This was strategic positioning based on data that could be measured and verified. He started typing. Phase 1, stealth accumulation. Condition: silver sustains above $93 for 5 consecutive trading days. Status: active. Silver had now closed above $93 for 8 straight sessions. The condition was met. In phase 1, the focus was on primary producers, companies that were already pulling metal from the ground, companies with immediate cash flow, companies where the profit explosion was happening right now, not in 3 years. He typed 2 names, Hecla Mining and First Majestic Silver. Both were established producers. Both had all-in sustaining costs around $20 per ounce. Both were currently selling silver at $95. That meant $75 profit per ounce. But their stock prices were still trading as if silver was at $55. The market had not repriced them yet. Why? Because the quarterly earnings had not been filed. The analysts had not updated their models. The institutions had not received confirmation. But in 2 weeks, the Q1 reports would drop. And when Hecla announced earnings that doubled year over year, when First Majestic showed profit margins that made no sense at old silver prices, the repricing would happen in a single trading session. Violent, fast, impossible to chase. The analyst knew this because he had seen it before. Not in silver, but in uranium stocks in 2283. The metal had quietly climbed for months while the mining stocks lagged. Then Cameco reported earnings. The stock gapped up 34% at the open. No chance to buy, no gradual climb, just an instantaneous revaluation. He highlighted phase 1 in green. This was the current play, the lowest risk entry point in the entire cycle, because even if silver pulled back 20%, even if it dropped to $75, these companies would still be generating $55 profit per ounce, still far above what Wall Street was modeling. He moved to the second section. Phase 2, premium confirmation. Condition: Shanghai premium sustains above $10 for 10 consecutive sessions. Status: monitoring. Currently, the premium was at $9, close but not confirmed. If the premium widened to $10 and stayed there, that would signal something critical. It would mean Eastern demand was not temporary. It would mean the physical shortage was deepening, not resolving. It would mean the arbitrage flows were not closing the gap. And if that happened, the next tier of companies would become investable. Developers. Companies with proven deposits, but not yet in full production. Discovery Silver was on his list, a massive silver project in Mexico, not producing yet. But if silver stayed elevated at $95, $100, or higher, the economics of bringing that project online would become irresistible, and the market would start pricing in future cash flows. But phase 2 carried more risk. These companies did not have immediate revenue. They were dependent on sustained high prices. If silver crashed back to $50, their projects would stall. So the trigger had to be clear. Shanghai premium above $10, sustained, not a one-day spike. He moved to the final section. Phase 3, institutional entry. Condition: SIL ETF volume exceeds 10 million shares per day for 3 consecutive sessions. Status: not active. Current average volume: 2.8 million shares per day. Phase 3 would mark the moment when the big money arrived. Pension funds, sovereign wealth funds, endowments. Institutions that moved slowly but carried enormous capital. When they entered, the volume would spike. You would see it in the data. 10 million share days, 15 million, 20 million. And when that happened, the entire sector would reprice. Not just the producers, not just the developers, but the explorers, the royalty companies, the entire food chain, because institutional capital did not discriminate. When a pension fund allocated 0.5% of its assets to silver mining, it did not buy just one stock. It bought a basket. And in a sector as small as silver mining, that kind of inflow would overwhelm the available float. The analyst had done the math. A single $100 billion pension fund allocating half of 1% would deploy $500 million. The entire SIL ETF had a market cap of roughly $5 billion. That one allocation would represent 10% of the sector. Now imagine 10 pension funds. Imagine sovereign wealth funds in the Middle East and Asia deciding they needed hard asset exposure. Imagine family offices that currently held 0 commodities, moving to 3% or 5%. The supply of shares was fixed. You could not create more Hecla stock. You could not print more First Majestic shares. And you definitely could not manufacture physical silver fast enough to satisfy exponential demand growth. So the price would do the only thing it could. It would gap higher until demand was rationed by price. The analyst saved the document and leaned back in his chair. 3 phases, 3 triggers, 3 levels of risk and reward. Right now, phase 1 was active. The opportunity was clear. Primary producers trading at valuations that assumed $55 silver, while the metal itself was at $95 and climbing. But the window was closing, not in months, in weeks, maybe days. He opened a separate tab and pulled up insider trading data. Over the past 3 weeks, 5 executives across 4 different silver producers had purchased shares. Open market buys, not grants, not options. Actual purchases with their own money. These were the people who saw the financials before anyone else. They knew what the next earnings report would show, and they were buying. That was not a guarantee. Insiders were wrong sometimes, but it was a data point. And in a market where most data pointed in the same direction, it mattered. The analyst checked the clock. 5:43 p.m. The markets would open again in 15 hours, and when they did, he knew exactly what he was watching for. The Shanghai premium, the COMEX inventory levels, the sale volume, and most importantly, the earnings date calendar, because in 2 weeks, the math would become public. The $75 profit per ounce, the 111% profit growth, the cash flow explosion happening in real time, and Wall Street would have no choice but to reprice the sector. The analyst had seen this pattern before, not in silver, but in every commodity cycle he had studied. The metal moved first, the stocks lagged, the analysts denied, the institutions waited. And then, all at once, the repricing happened, fast, violent, unforgiving to those who hesitated. He closed his laptop and stood. Outside his window, the city lights were beginning to flicker on. Somewhere in Shanghai, traders were already positioning for Monday's open. Somewhere in London, vaults were being drained to meet Eastern demand. Somewhere in Mexico and Peru and Canada, mining trucks were pulling silver ore from the ground. Ore that would be refined and sold at $95 per ounce, generating profits that Wall Street had not yet priced in. The analyst walked to the door and turned off the lights. The thesis was complete. The framework was clear. The only question now was whether the market would wait for confirmation, or whether it would move before most people realized what was happening. He suspected the latter, because in 12 years of tracking this sector, he had learned one unbreakable rule. The market does not wait for consensus. It rewards those who position early, and punishes those who wait for certainty. The unobtainium phase had begun, not because silver was rare, but because it was becoming unobtainable. And when a critical industrial metal crossed that threshold, when paper markets diverged from physical reality, when institutional capital started chasing a sector with no liquidity, the physics changed, the rules changed, and the 25% lag between the metal and the miners would close, not gradually, but all at once, in a single violent repricing that would leave most investors standing on the sidelines, wondering how they missed it.